Welcome, everyone. Thank you so much for joining us today. We appreciate you taking the time to be here and to learn about tax smart gifting. My name is Myra Medina. I'm an estate planning paralegal for the Koppenbarger and Koppenbarger law firm. Your presenter today is Robert Galliano, and he is one of 8 attorneys within our firm. Robert has been practicing law for over 37 years. He has a master's in taxation, is a certified specialist in probate, estate planning, trust law by the State Bar of California, and is a VA accredited attorney. Robert has helped hundreds of families over the years. You will find that Robert comes with a wealth of information and tons of experience. He takes the very complex and makes it simple. Here you'll notice that we have 8 attorneys and dozens of support staff that are highly qualified and happy to serve you at any time. We have offices all over the state of California, and we can meet with you in person or through virtual means such as this. So now I'll hand it over to your presenter, Robert Galliano.
Thank you, Myra. The agenda that I have on your screen is what we're going to follow. We're going to be spending about maybe 45 minutes together. The discussion today and the subject matter today, I think is going to be of a great interest to all of you, particularly those of you who are charitable minded and have IRAs. We're going to be discussing the ways that you can gift, and also how the Secure Act impacts charitable gifting, and also a topic which I will probably spend a little bit more time on, which is called the qualified charitable distribution. And then I will discuss how you can generate a lifetime income stream for people who haven't inherited an IRA. And then I will summarize with tax smart gifting. And then Myra will come back and offer how we can help you. Ways that you can gift. We all know that it is far better to give than to receive. There's a lot of studies that have been generated that indicates that the behavior of gifting leads to increased happiness. That's psychologically proven today, and I think most of us have experienced this. We give to the church, we give to needy people. We feel good inside that we're helping others that are needy. And the research also shows that there's a link between giving to charity and a certain increased activity in sections of the brain that register the pleasure that we get from gifting. And again, the old saying really is true. It is far better to give than to receive. We all know that. But the thing that I want to concentrate on is what I want to teach you today is to give you an overview as to what is the best way from a tax standpoint to give to charities. And we're going to be talking about asset-based gifting. And you all know what this is, but I want to cover it so we're familiar with what we're going to be talking about. Then we're going to jump into the subject that I really want to concentrate on, which is called the IRA qualified charitable distributions. And then I will talk about charitable trusts and how we can use them to provide a lifetime of an income stream. We can give cash contributions. We can give non-cash assets, like, for example, a car. Or we can also give appreciated non-cash assets, like maybe stock that you paid $100 per share is now worth $400 a share. That would be an example of a appreciated non-cash asset. We're familiar with giving cash, and there are certain limitations that the IRS provides or imposes upon us. And basically, the term AGI, that term, which is an IRS term, refers to the adjusted gross income. This is a tax term, and everybody that files a tax return, your 1040 form, for example, that we all have to file at the end of the year or beginning of at least before April 15th of next year, there's a line that basically says your adjusted gross income. Well, that number in the world of gifting from the IRS standpoint limits the amount that you can gift, and that amount limitation is based on the type of asset that you give. For example, non-cash assets held longer than 1 year, that's long term. The amount that you can give per year is limited to 30% of your adjusted gross income. And if you give cash contributions, the limitation is 60% of adjusted gross income. Now, at first blush, you say, well, I think I better give a bunch of cash because I'm allowed to give more cash than non-cash assets. Well, the problem is that most of us have non-cash assets in our portfolios, and we do not have a lot of cash just sitting around. Probably not a good idea to have so much cash laying around. We should have it invested in some form of an investment to give us some sort of return. But then the other point that I want to make is that we're subject to taxation almost everything that we do in life. And there is a term which we're all familiar with, which is long-term capital gains tax. Now, long-term capital gains tax at the federal level is you can either pay 50% or 20%, and that is based on your income level that you are. So for this discussion, I'm just going to assume that a taxpayer is at the 20% capital gains tax. So the strategy that is best for giving, at least this particular type of giving, is to give appreciated assets that have built-in gain. For example, if you have stock that the fair market value is $100,000, but it has a $90,000 gain in it. If you look at the table below the writing, you're going to see two columns. The one column says stock given to charity, and the other column says stock sold. So if you look at the stock given to charity, if you give the appreciated asset to charity, there will be no capital gains tax. So the tax is zero. So the amount given to charity will be the full fair market value of the stock, or $100,000. If you go to the second column, it says stock sold. So if you sell the stock, if you're in the 20% capital gain number, right, the rate, then you're going to get stuck with paying $18,000 in capital gains, and therefore the charity would have only received $82,000. So when you have appreciated assets, that is really the best way to give to charity, because A, you will not have to pay capital gains tax because the assets given to a charitable organization, and there will not be any capital gains tax, and then the charity will get the full value of the asset that you gave away. So in this scenario, when you're looking at non-cash assets, cash contributions, the best strategy is to give away appreciated stock, appreciated assets. There is something else that I need to make you aware of, and that is that we are all aware of gift tax, and I need to spend a couple of minutes to review where we stand on the federal gift tax rule. We are, as taxpayers, given, all of us, an amount of $12,060,000 for this year, a number that is exempt from gift tax and death tax. It's a one-time amount that we're given during life, If we use part of it during life, then we only have a remainder part of it to use at death. For example, we're given $12,060,000 to be exempt from gifting and death tax. If we use 5 million of that during gifts during our life, then there's only the remainder amount of the 12 million, maybe about, let's say 6 million plus available at death. But in the context of gift tax, you can give away as much as $12,060,000 this year without having to pay any gift tax. You will have to file a form called 709 to report to the IRS the amount of money that you give away in gifting. So there is the ability to gift away a lot of money without having to pay any gift tax. And you are all familiar with the amount that you can give per year to any person, which is $16,000 per person. And that is what we call a gift tax exclusion. So there's two rules in the gifting world. One rule is the $16,000 per person that you can give to millions of people. It does not matter. That's a different rule than the $12,060,000 that I discussed earlier. So you have the ability to really gift away a lot of money during the year. And every year, the number, the $12,060,000 is increased by inflation. And there is one thing that I want to make a point of, and that is that the current law, this 12 million plus that gets increased every year. In 2026, the number will go to about half of the amount because the current law will cease to exist in 2026. So the amount that would be exempt from all transfers, gifts, and so forth will be probably around 6.5 million in 2026. Let's talk about the Secure Act and how did the Secure Act impact gifting? I'm going to review the Secure Act in a very, very general, superficial form because we do have webinars that we have on our website that address the Secure Act and how it works in more detail. But what I want to focus on is how did the Secure Act, how in the heck does this Secure Act impact charitable giving? What are the effects? What are some of the charitable giving opportunities that we still have? These two opportunities that we have, which I will discuss today, is what we call the qualified charitable distributions, and then also the testamentary charitable remainder trust. So let's jump in to see how the Secure Act basically impacting gifting particularly. You may recall that the Secure Act is a recently passed law that is aimed at IRAs that are inherited. The current Secure Act has the following mandate. For most non-spouses, as children, brothers, sisters, uncles, non-spouses who inherit an IRA, they have to withdraw the entire amount from the IRA within a 10-year window. And recently passed regulations also impose the following. During years 1 through 9, they have to take out required minimum distributions. And by the 10th year, they have to take out the remainder of whatever is left that they have not taken out during the first 9 years. And the penalty for not taking everything out within the 10-year window is 50% of the amount of money that you did not take out by year 10. What are the negative consequences of taking money out? Can you imagine, for example, that you leave a $100,000 IRA to a son? Maybe the son is 40 years old. Under previous law, when somebody inherited an IRA, in this example, the 60-year-old child, adult child, let's say that he had another 40 years of life left. Well, the child under previous law pre-Secure Act law, could take out the required minimum distributions of the inherited IRA over his remaining lifetime, which means that the $100,000 that you would have left him, he had at least another 40, 50 years of time to take out small amounts of money and continue to have the account grow in a tax-deferred manner. That generally was discussed, and the acronym was Stretch IRA. So the Secure Act, if we take the $100,000, for example, is that you give a child $100,000 and they say he's 40 years old, he has to take out the money over the next 10 years. So let's just, for argument's sake, take the $100,000, divide that by 10 years, and assume there's going to be taken out $10,000 every year, just taking out an equal amount of money every year, years 1 through 10, $10,000 of income. What would happen to the child's income tax? Generally, the adult child is probably in the best time of his life in earning capacity. And all of a sudden, he has to take out another $10,000 every year. That's going to impact his tax. It might put him in a higher tax bracket. And also, it may impact adjustments for Medicare premiums, because you know that Medicare premiums, the payment on some Medicare premiums are tied to the amount of income that a person receives. The Medicare premiums, the payment adjusts depending on the amount of income that you make or that you have, and therefore receiving another $10,000 a year of income could impact the cost of the Medicare premiums, and also it can impact as to how Social Security payments are taxed. Now, Social Security payments, as you know, they can be taxed at different levels. If you are, for example, a married couple and you have an income on Social Security that's about over $44,000, your tax on Social Security payments can be up to 85% of the payments that you receive. So receiving $10,000 a year more of income can impact not only you with your higher tax bracket, but it can also impact the amount of taxes that you pay on Social Security payments and also Medicare premiums. So what else did the Secure Act do? Well, we all know that it increased the required beginning date, the time when you have to take out the required minimum distributions, from age 70 and a half to 72. And it also repealed the maximum age for contributions to traditional IRAs. It used to be you could not contribute to IRAs after age 70 and a half. And now if you continue working, let's say you're working and you're old, maybe you're 85 years old and you're still working, well, you can still contribute to an IRA. So that was a good thing that the Secure Act did. So how does the Secure Act then impact qualified charitable distributions? Well, the one thing that I have to explain is, what is a qualified charitable distribution? It is a really neat tax advantage gifting idea that very few people implement, and I want to make sure that you understand how it works. So, number one, those of you with IRAs, and those of you, for example, that have passed the age of 70 and a half, and for those new people who, after the Secure Act, reached age 72, you know that you're required to take out required minimum distributions every year. You are forced to take out RMDs every year. When you take out a RMD, that amount of money that you take out is added to your income tax, is adding to your income, which increases your tax liability. However, if you transfer that RMD directly to a charity, that RMD transfer to the charity can satisfy all or part of your RMD for that year, and the money, the RMD money that you transfer to the charity is not considered income to you. So you can take out an RMD, give it directly to your church. They get the benefit of the full amount of money that you give them, and you do not have to report it as income. A qualified charitable distribution excludes the amount donated from your taxable income, which is unlike the regular withdrawals from an IRA. You take a withdrawal from an IRA, your RMD, it will be added to your income and taxed. If you transfer the RMD directly to a charity, it is not considered income, and you qualify then for the RMD that was required to be taken. So this keeps your taxable income lower, and again, it may reduce the impact on certain tax credits, deductions, including Social Security and Medicare. Normally, when you have a normal charitable contribution, you have to itemize. So a lot of people do not do charitable distributions, the normal. I'm not talking about IRA qualified charitable distribution. I'm talking about the regular ones that you would do when you give a car, for example, or you give cash. In order to take that deduction, you have to itemize on your tax return. A lot of people, because the laws recently gave us a larger, I'll call it standard amount of money that you can deduct, so you don't have to itemize. People don't give because they had to itemize. But a qualified charitable distribution, you do not have to itemize. So that means that qualified charitable distributions do not require you to itemize, which due to the recent tax law changes means you now can decide to take advantage of the higher standard deduction that we currently have and still use a QCD for charitable giving. Here's how it works. Let's assume that you are required to take a RMD out this year and the amount is $5,000. You have to take it, no question. If you take it, the normal distribution would go into your income and you'd be taxed on it. If you take out the RMD, and let's assume that you want to donate to your favorite charity or favorite charities, the amount of $5,000, let's say to your church, you can transfer the RMD directly to the charity or charities, and your RMD will not be counted as income to you. Taking your RMD will not increase your tax. It will not put you in a higher tax bracket, and it will not impact Social Security and Medicare. So the IRA RMD transferred directly to your charity would satisfy your RMD requirement, and it will not be taxable to you, and the charity would get the full amount of the distribution. So an IRA qualified charitable distribution, if you do a direct transfer of your IRA to your church, there's no impact on your taxes, and you do not have to itemize. That is a win-win situation for everyone. Now, I've had some of you submit questions on qualified charitable distributions, and I'm just going to read some of the questions. And I think you find it interesting. This is an opportunity for me just to answer some of the questions. Now, the one question is there a limit on the amount that a qualified charitable distribution and the amount that you can give? And the answer is yes. Qualified charitable distribution, QCDs, are capped at $100,000 per person per year. And if you're married, that's $100,000 per person. So that would be $200,000 for a married couple. They only apply to IRAs. Inherited IRAs count, but they do not apply, for example, to pension plans or anything like that. The distributions can be done from IRAs, they can be done from Roth IRAs, and they can be done from what we call inactive SEPs. But the basic rule is that you really use this as an IRA qualified charitable distribution. The QCDs must go directly to charity, not gifts made to you first, or you, in other words, you take the money out first and then give to charity. That will not work. And you cannot make gifts directly to private grant foundations or donor advised funds. And again, the charitable donation from the IRA will satisfy your RMD for that particular year. And again, the married couple, each of you have up to $100,000 that you can take. So that's what, $200,000 for a couple. And pretty much that's the questions that people ask. And then as far as the reporting aspect of it, there is a line on your 1040 tax return that you report, that you basically put down that you got the distribution, but then you put down that it's no tax, and everybody will identify if you put that it's a qualified charitable distribution, that you will not be added to your income tax. All right. Now, I'm going to switch horses now, and I'm going to talk about another impact from the Secure Act. And this is, again, how can we generate a lifetime of income stream? Now, again, let me review one more time. Previously to the Secure Act, if you inherited an IRA, a non-spouse person inherited an IRA, again, the 40-year-old person who inherited the IRA, they would have another 40 or 50 years alive to take out money, small amounts of money every year, allowing the account to grow, and therefore they would have pretty much an income stream over their lifetime. That was before the Secure Act. Again, the Secure Act forced everybody, non-spouse who inherited an IRA, to take it out within 10 years. So how in the heck now do you get an income stream from an IRA when the IRS forced you to take it out within 10 years? There's no way that you could go to get an income stream for life. So here's how you do it. We're going to use another tool called a charitable trust. Charitable trusts come in different flavors. I'm going to be talking about one that's called a charitable remainder trust. And what that simply means is that during the life of the charitable trust, the donor who created and transferred money to the charitable trust, they would be the income beneficiaries during the life of the donor. And then the money that would be left in the charitable trust at the end of the donor's life, the remainder would then go to their favorite charity. So a charitable remainder trust usually is to allow the donor of the property that was gifted to the trust to receive an income over their lifetime or 20 years, but the remainder that's left in the trust would go to the charity. So here is how we use a charitable remainder trust with an IRA. You name a testamentary charitable remainder trust, that is one that is not funded until the death of the donor. And you accomplish identifying the charitable remainder trust as the beneficiary of the IRA by changing the beneficiary form, not by changing trust provisions or will provisions. It has to be done with the beneficiary form of the company that holds your IRA. You know very well that IRAs transfer by beneficiary form. So if you want to change the beneficiary of an IRA, you change the beneficiary form. So here is a visual as to what I'm talking about. Let's assume that you have an IRA. Let's use the example again. You have a 100,000, let's say this larger number. Let's say you have a $500,000 IRA. During lifetime, you are the owner, you benefit from the IRA, it's yours. But through the change of beneficiary form, you name the beneficiary of your IRA the testamentary charitable trust. So you have the IRA, the beneficiary of that IRA is your testamentary charitable trust. While you're alive, you're using the IRA money like you normally would, but upon your death, the IRA then is transferred to the charitable trust. That is when the charitable trust then will receive the IRA. It's a charity, so there's no taxation when you transfer the IRA to the trust. The trust will not pay any tax of income generated or any gains generated within the IRA. The IRA can be managed by your investment counselor, and the testamentary charitable trust can be drafted in a manner that it can provide income to the spouse, income to children, and all depends on how that trust is set up. But that income can be for life of a person or life of two people or up to a period of 20 years. There's some very technical requirements in preparing a testamentary trust. But the idea then is that the IRA now that is inherited by the testamentary trust, there is no 10-year requirement to take money out. The money can be then taken out over a lifetime. And at the end of the term, when people who were receiving the income die, then the remainder goes to charity. So previously, an inherited IRA under the Secure Act, now you have 10 years to take it out. There's no way you're going to be able to get a lifetime income stream with that scenario. If you simply leave that IRA to a testamentary charitable trust, that instrument can be created and drafted in a manner that will provide an income stream for lifetime for the beneficiary. So you've converted an IRA then from a 10-year limitation to a lifetime of income that can be paid out. And at the remainder of that, or when the beneficiaries die, the remainder goes to charity. So the CRT is funded with the IRA at the donor's death. It will provide the beneficiary with predictable income for life. It will preserve wealth because the money in the charitable trust can be invested. It cannot be, because the person who's the beneficiary did not receive it outright, they can't sell it, they can't get rid of it, which normally when people inherit an IRA, they never earned it. So the first knee-jerk reaction is to sell it, and who cares the amount of money that they're having to pay in tax? Not only does it preserve wealth, but it can protect assets from creditors, because once it's in the charitable trust, creditors cannot attack it. And again, the remaining balance of the trust will be a legacy, a gift to your favorite charity or charities. All right. Let's review. If you're going to give appreciated assets, or if you're going to give cash and non-cash assets, the best way to do it is to give appreciated assets. 2, remember to be able to use the $16,000 per person per year gift tax rule. And in addition, you have the $12,060,000 gift tax rule. And if you have an IRA that's been inherited, then they can use testamentary CRTs to generate a lifetime of income. And for you, if you have an RMD due, which is generally due by this December 31st at the end of the year, you can take the RMD and it has to go directly from the trustee of your IRA to the charity, and you can qualify for the RMD and give the charity the full pop of the money. We can help. Myra is going to now talk to you about how we can help.
Yes, thank you, Robert. I did notice 2 questions on the chat box here, on the Q&A box. Robert, so I'm going to go ahead and read those. The first question is, must the recipient organization be a charitable organization?
The answer is yes.
Okay.
It cannot be a self-directed fund. It cannot be a donor advised fund. It has to be a charitable that qualifies as a charity under the IRS rules. That's correct.
Okay, perfect. The second question is, can one take some of the RMD to give directly to more than one charity and not be a large amount to each? Basically, perhaps take half of the RMD for oneself, then 25 to one charity directly, and 25 to another charity directly. Is that doable?
You can use the RMD and provide it to multiple charities. The only requirement is that the distribution has to be directly from the trustee of the IRA to the charities. But that is 100% correct. It doesn't have to be one charity, it can be multiple charities. And that's a fantastic tool, because think about it. All of you who have RMD requirements at the end of the year, and if you're charity inclined, take advantage of this. Otherwise, the RMD is going to be added to your income and you're going to be taxed. So that's a very good question. All of these are great questions.
Mm-hmm. Okay, I have one more. I want to give all of my IRA on my death to 4 individuals living in Asia. Are there tax issues?
Repeat the question again.
Yes, so this person would like to give their IRA to upon their death to 4 individuals, and these individuals live in Asia. So is there any tax issues with that?
Well, from the US tax code, they're going to be inherited the IRA, and if they're non-spouses, they're going to be under the Secure Act, and that's the limitation that they would have. But the fact that they live in another country, that does not mean that you cannot give it to them. Now, I don't know what country it is, but there are some countries that have foreign tax relationships or treaties with the United States, and therefore you have to look at whatever country the people live in to see what the impact is of the amount of money that's being given to them on their tax return for that particular country. But otherwise, from a US standpoint, no, the people would be given the IRA. They would have to play then by the IRA rules that we have here in the US tax code.
Okay, thank you. And last one, I lied, there's one more. Do all of the RMDs have to go to charities?
The question is, let us assume that you have.
Actually, Robert, real quick, they updated the question. So the question is, can half of the RMD go to a charity and half to oneself?
Have what?
So can half of the RMD go to a charity and the other half to oneself?
Yes. Let me go through that one. Let's assume that you have a $10,000 required minimum distribution, okay? You can then allocate, let's say, $5,000 to the charity, and the $5,000 then, if it's going to a spouse, now remember, the spouse has the ability to, quote, take money out piecemeal over her lifetime. It's a different rule for spouses. But as far as the RMD is concerned, the only RMD that would be eliminated from your tax would be the amount that you give directly to the charity. The amount that goes to a non-charity, then that would be normally added then to your income tax. You follow? So you can't split it, but the only amount that would be excluded from tax would be the amount that goes to charity. But you can't split it to charities and to non-charities. That's correct. Good question.
Perfect. Thank you, everyone, for your questions. As you can see there, this topic brings a lot of different questions, and maybe we didn't get to answer yours today, but I definitely want to invite all of you. By joining this webinar, you do get a complimentary consultation with one of our attorneys. So again, just thank you for joining the presentation. We hope that you've received valuable information about TaxSmart Gifting. And remember, you've worked really hard your entire life to build what you've got. And whether that's a little or a lot to you, it's worth protecting to us. So again, if we didn't get a chance to answer your questions, we will most certainly answer it during your complimentary consultation. Lastly, we want you to know that we're here to help you through all the changes and all the life changes from beginning to end. And if you haven't established an estate plan, or you'd like to update and have specific language regarding this topic, please contact us. Our number is 1-800-244-8814. You can also visit our website. We will be happy to schedule a consultation with you. And again, thank you so much for joining.